Now let's bring in our guest host for this hour, Chris Kimber, Managing Director at Kimber Capital. I'm sure you've got a couple of those.
Oh, look, I just love the big bazooka, adequate size. Don't worry, it'll be big enough. It sounded more like speed dating to me rather than an economic comment. I'm sorry.
I don't know whether we should continue this
Don't continue that conversation.
It's not big enough, though.
Yeah, that's it. Well, clearly that's the case. But look, what amazed me about this is the market's actually had a reasonable rally into it, and the market's rallied 10 points since I left my desk this morning. I mean, it's a knee-jerk reaction down 40 points on the fact that he didn't do anything last night. I mean, he's come out, he said we're going to do something. He didn't say we're going to do something tomorrow. He didn't say we're going to fire the bazooka tomorrow night. What they do, this is a game of brinkmanship, as we've discussed, and they continue to squeeze it for as long as they possibly can. So as long as nobody's going to fail, as long as Spain's not about to drop off, they keep squeezing a little bit more money out of anybody that they can along the path. So I still think he's doing the right thing. Maybe he toned his language down a little bit last night. It doesn't need to be one big bazooka. I mean, the amount of money that a lot of the rich economies that have made by the delays thus far. So the difference for us is we keep thinking about it from share prices. And doing what I do, I love it when they go up every day. But Mario doesn't care. All Mario cares is that he has it under control, and that when he spends the money and he fires the bazooka, he fires only as much as he needs to keep things going and to rectify the situation.
You know what's hard here for investors out there, Chris? And that seems to be what they're doing in terms of trading, because what all we're seeing right now is positive news, markets go up. People are in there buying stocks. Negative news, people are selling stocks. And it's not just the equity markets, of course, but it's a very clear trend here. This doesn't seem to be likely to change in the near future. No. So all you're doing is trading news.
And that's exactly right. And but that is what the market's doing. The market is trading headlines, and we've discussed this many times before. There's high frequency trading, and there's a whole heap of people out there trying to keep their jobs that get paid on a monthly basis and on a monthly performance basis. So if you're sitting over at JP Morgan or somebody like that with $100 million as a proprietary trader, and at the end of every month you have to make 1%, you need to make decisions today and tomorrow on these headlines. Can I add a little bit of value this week? That's not the way the average person should be trying to trade their portfolio. On the days like today, when things get oversold over a short-term headline which really doesn't mean too much, except that the decision or the bazooka hasn't been fired for a few more weeks, you're out there looking for anything that might have been oversold. The market's been sneakily rallying. It's off 40 points today. The market's had a 10% rally across the board. Half to two-thirds of our industrial stocks and defensive stocks are hitting all-time highs. Really, the argument gets down to yesterday we even had BHP and Rio rally. So it'd be a little bit ridiculous if we had all of our stocks across the board rally. The US market's still sitting, pre-GFC index highs on these things. But we sit here talking about all of these headlines as though the worlds are ending. In the meantime, plenty of investors are making a lot of money out of this.
Yeah, well, at least somebody is out there. Chris, stay with me for a moment, because I want to get a look at the reaction on Wall Street to Draghi's comments. Let's get a look at the boards here. All are lower. Dow Jones down by 0.7%, as was the S&P 500, the Nasdaq down by 1/3%. These are off the day's lows, though. We should point this out. We're turning now to tonight's non-farm payrolls. That's another bit of news that I'm sure we're going to react to on the markets. Shri, I know that you've been looking at expectations, as we talked about earlier. They centre around the $100,000 mark, but likely to disappoint once again.
They do. I think it's going to be an underwhelming figure. The variation in terms of the forecasts have been all over the place. I'll talk about that in a few moments' time. But as far as the whisper number is concerned, we are looking at the US economy to have created 100,000 new jobs in July. That would represent something of a pickup from the 80k print that we saw in June. But even if we see a figure of this magnitude, it will not be enough to put a sizable dent in the unemployment rate, remains stubbornly high at 8.2%. In terms of broad thematics for this report in July, we're going to continue to see the public sector in the US shedding jobs. So expect to see a decline, according to the forecasters, of 13,000 in that sector in July. As I said, there is quite a wide variation in terms of the individual forecasts. But one thing is for sure, and this is a common strand running through all the economists' commentary, seasonality will play a part, as it typically tends to do in the data. On the most pessimistic end, RBC's Tom Pacelli is expecting just a meagre 60,000 payroll addition On the other end, Societe Generale's Brian Jones, most optimistic. He's expecting to see 165,000 jobs being added in July. Now, one thing is for certain, corporate America is less confident about hiring in the current climate, especially when we don't have much certainty on the fiscal position. And remember, on top of that, the labour market is still trying to rebuild after the 2008 financial crisis. From peak to trough, Oriel, the US labour market has lost some 9 million jobs. Market has rebounded off its lows, but it's only managed to restore 45% of lost jobs. So, put it all together, what does it mean for the markets? A subpar number could build a case for more accommodation. So we once again could be in this kind of paradigm where bad news is good news for the markets. We are awaiting Jackson Hole. That's going to be critical. Bernanke may drop some hints about further accommodation, but the broad market consensus is suggesting that September, the meeting then with the FOMC, could see some concrete action in terms of further stimulus. We'll have to wait and see. Back to you.
Yeah, no, just before you go, Sri, I've got someone sitting beside me who's just dying to have a chat with you.
Well, Sri, no, it's just,
Chris,
you're sitting in the
mate?
centre of the universe. I'm very well, Sri. I hope you're well as well. Look, you're sitting in the centre of the universe of all this sort of stuff. I want to know who to barrack for, because it seems hard to work out on these payroll numbers. I mean, they're lagging indicators, but is the market going to rally dramatically if we get a bad number because then QE3 is on the way, or is it going to sell off if the US economy is actually doing reasonably well? It seems that the pessimists can make a case either way.
You raise a very good point, Chris, and I think this is a market that seems to be so addicted to stimulus, or so addicted to the idea of stimulus and conditioned like Pavlov's dog to expect further stimulus from policymakers when things are going awry in the broader US economy, that I think it's almost invariable that, like I said earlier, if we see a subpar number, then that's really going to generate some calls for further action from the Fed. As to the timing, it could be a bit tricky, but what we are hearing is that the September meeting could be absolutely critical. And let me just emphasise this again. A CNBC survey done by Steve Leisman and his team over the US suggests very strongly that most in the market are banking on some action by the Fed in September. 12th to the 13th of September, that's when the meeting is. Chris.
It's in the diary already.
Well, there we go. Buy Silver Lake and Newcrest Mining, and we'll see gold back up towards 2,000 instead of 1,700. There you go. You heard it from Sri.
That's putting words in your mouth there, Sri. Thanks for that. We might chat with you a little bit later on in the program. Jackson Hole, of course, as well.
Yes.
September 12th to 13, yes, but Jackson Hole seems to be where the next focus.
Yeah.
And that's where it's happened before.
Yeah. Listen, my favourite thing is the terminology is the kicking the can down the road. Because really, when you're sitting in these guys' positions, and this is Mario's position and Bernanke, who you might notice are sounding a little bit more like each other over the last couple of weeks, what they want to do is they want to maintain everything and do as little as possible. So every time everything starts to tank, they go, no, we'll do everything possible. But then when it picks up, then they don't do anything and postpone for a couple of weeks.
What's the point of that, though? That's not changing anything.
Well, what it means is they don't have to spend any money, and then what they're hoping is that there is a natural pickup in progression and sentiment changes, and that things start getting better by themselves without having to fire that bazooka anytime soon. So, whether that is good and how much money they've saved by delaying it this far already, I can tell you the Germans are a lot happier. If the bazooka had been fired this time last year, it would have cost the Germans a lot more money than it might cost them now.
And we might be in recovery. Who knows?
And you and I would be happier and our share portfolios would be higher, but perhaps on a worldwide basis they don't quite think the same way.
Yeah, perhaps not. Perhaps not. We're going to talk about this some more in just a little bit. Now, of course, if you've got any questions for myself, for Chris, for any of our guests on the program, or comments, drop us an email, cashflow@cnbcasia.com, or you can get in touch with me on Twitter. Just follow me @CNBC Oriel.